All right, welcome to The Explainer. Today, we are diving into something that hits your bottom line on every single trade. How are you really paying your broker? We're going to break down this battle between the invisible spread and the upfront commission and figure out which one might be quietly eating into your profits. So let's just start with a really blunt but super important quote from inside the brokerage industry. It lays out a model where, essentially, your broker is on the other side of your trade. What does that mean? It means every dollar you lose can literally be a dollar of revenue for them. It's a pretty stark reminder of why we have to pay close attention to every single cost. And that leads us right to the big question, right? Especially with all these ads for commission-free trading. I mean, how are they making money? The cost is always there. You just have to figure out if it's a clear, transparent fee or more of an invisible tax that's hidden in the price you get. Okay, so here's how we're going to break it all down. First, we'll talk about the real cost of trading. Then we'll dissect the spread. After that, we'll look at the transparent commission. We'll run a head-to-head cost showdown with some real numbers. And finally, we'll talk about how this all gives you your edge. All right, section 1. First things first, let's get a core principle straight. No matter what the marketing tells you, there is no such thing as a totally free trade. So just remember that. Every single time you click that button, a fee is paid. Understanding how it's paid is the first step in picking an account that actually works for your strategy, not against it. And this isn't some minor detail. It's absolutely fundamental to your profitability. Okay, section 2. Let's break down the most common way brokers get paid, the spread. And honestly, the best way to think of it is like an invisible tax on every single transaction you make.
So what is it really? Well, it's just a gap. At any given moment, you'll see two prices on your screen, the price where you can buy and a slightly lower price where you can sell. That little gap between them, that's the spread.
So you've got the two sides of the market right here. The ask, which is where you buy, is always going to be higher than the bid, which is where you sell. On a spread-based account, the broker's profit is just baked right into that gap. It's as simple as that. And here's the kicker. This means the second you enter a trade, you're instantly at a small loss. You have to literally climb out of that hole created by the spread just to get back to zero. It's a built-in hurdle you have to clear on every single trade. So what's the alternative? Well, let's look at the other model. This is the one favored by high-frequency traders, algorithmic systems, and scalpers. And for one simple reason, it's totally transparent. Unlike the spread, this is an explicit charge. It's not hidden in your fill price. It's a line item on your statement. You can think of it like getting an itemized receipt for your trade. The process here is incredibly straightforward. You get a much tighter spread, often called a raw spread, that's coming straight from the big liquidity providers. This means you get a way better entry price, and in exchange for that direct access, you pay a clear upfront fee. So, which model is actually cheaper? This isn't just theory. It has a massive impact on your bottom line. Let's run the numbers for a short-term trader, what we call a scalper. This is a classic scenario, right? Scalpers are aiming for really small, quick profits. They might be in and out of a trade in just a few minutes. Let's see how the two different cost structures totally change the outcome on the exact same trade. Okay, let's just look at the bottom line. The numbers don't lie. On the spread-based account, the total cost for this one trade is $12. But on the commission account, even after paying that explicit fee, the total cost is only $8. For the exact same trade, the scalper keeps $4 more in profit. Now imagine doing that dozens of times a day. It adds up fast. I mean, think about that. Nearly a quarter, a full 24% of the intended profit was just gone, eaten up by that invisible tax of the wider spread. For traders who rely on small, consistent gains, that can be the difference between a winning strategy and a failing one. It's a strategy killer. All right, let's pull this all together. The point here isn't that one model is good and one is bad. It's about which model is right for your strategy. This is where you find your edge. And the math here is just unambiguous. It's why the pros take this stuff so seriously. High-frequency and algorithmic trading systems pretty much exclusively use a commission model because when you're trading that often, minimizing your execution cost is everything. It's not a suggestion, it's a necessity. So here's what it all boils down to. If you're a scalper or you're running algorithms, the math is clear. A raw spread plus commission account is absolutely essential. Now, if you're a longer-term trader holding for days or weeks, sure, a spread-based account can still work. But the professional mindset is this. You always know your total cost to execute a trade. And remember, commission-free is almost never actually free.
And we'll end on that question for you to answer yourself. Go look at your broker statements. Calculate your real costs. Is your account actually built to help you win, or is it silently chipping away at your profits? You have to make sure your setup is giving you every possible edge you can get.